South African lender Nedbank posted a 20% rise in full-year profit as it benefited from higher interest rates. Nedbank says it expects the economic environment in the country to remain challenging, particularly given the high levels of electricity shortages. For more, we are joined by Nedbank CEO Mike Brown. Mike, thank you so much for your time. With this background that we can characterize as difficult, both locally and globally, how would you describe the performance of your business clusters when you look at the period that was for Nedbank?
We were certainly very pleased with what we were able to deliver in what we know is a very difficult environment globally and domestically, for our clients. And to be able to post 20% earnings growth, improvements in return on equity, and to get our capital levels to 14%, which is an extraordinary high CET1 level, declare a full-year dividend up 38%. We're very pleased about all of those, and those were underpinned by double-digit earnings growth in every one of our underlying businesses and improvements in their own return on equity. So in a tough environment, we were certainly pleased with what we were able to deliver, but our ROE is still below where we would like it to be.
When it comes to load shedding, that happens to be the common thread, especially when we look at some of the earnings that have been reported on SENS lately. Have you seen a material impact on your operations when it comes to load shedding, or are your clients starting to see that impact?
Yeah, so as a bank, we've certainly worked really hard to make sure that there are very limited impact on our own operations. We probably spent just under 60 million rand on diesel last year, but we were able to keep our systems and services up and running to enable our clients to access our products and transact. By far the larger impact from load shedding is the impact on the economy, which in turn impacts our client base, our lending growth, and our bad debts. And, certainly we can see the devastating impact that is having with economic growth. Last year, we now saw coming in at 2%. We saw the fourth quarter was negative. Likely that the first quarter of this year will also be negative. So that puts us firmly in the recession territory. And we're expecting now very low levels of economic growth in 2023. We've just revised down our forecast from 0.7 to 0.4. And that's the real pain from load shedding emerging for all South Africans.
We'll come back to the economic side. I want to talk about the credit quality. Are you starting to see the stress, and where is it evident?
So it's still early to see stress in our portfolios that you can purely attribute to load shedding, but we would certainly see some of it starting to emerge, more particularly in the SME environment, where quite simply those businesses do not have the resources to be able to cope with consistent levels 4, 5, and 6.
Right. So when it comes to this economic environment that you've just described and the impact of load shedding, what does that do then for, I suppose, your guidance, and I suppose also when we include the conditions in the banking industry? What's your outlook for that, given the fact that we're dealing with so many structural issues?
So certainly from our point of view, in that sort of environment, we try to focus on those things that we can control, delivering on our strategy, the ongoing incredible progress we've made in digitization, lifting our client satisfaction scores now to the top levels in the industry. And we think all of those things combined should enable us to continue to grow earnings and improve our return on capital, notwithstanding the headwinds from the external environment.
The one thing you talk about is the idea, or rather the issue of progress on these structural reforms being far too slow. What should we be focusing on in the immediate term in order to be able to bring in that investor confidence, especially, I suppose, even public confidence about whether we have a plan or not?
So certainly in our minds, there are three big issues here: energy and Eskom, logistics and Transnet, and water. Those should be our absolute focus. And all of those are underpinned by poor service delivery in many municipalities and unacceptably high levels of crime and corruption. If we can focus on those things that I've just mentioned and begin to show real progress, in other words, connecting new electricity supply to the grid, reducing crime rates, etc., I think that's what investors are looking for. They They understand that many of these things are longer-term fixes, and they know South Africa has extraordinary longer-term potential. But we need to be able to show the stepping stones in that direction in terms of our delivery. And unfortunately, to date, we have simply been too slow.
You've introduced the idea of a 5 billion rand share buyback program, and I wanted to talk about the rationale behind that in this particular time.
Yeah, so that's all about optimizing the capital across the bank. There are various ratios that describe capital. One of them is a ratio called CET1, Common Equity Tier 1. And there we expect over time to have that ratio somewhere between 11 and 12% at Nedbank. And right now it's at 14. So it's well above the top end of our board-approved target range. And in fact, even after executing a 5 billion rand share buyback program, it will remain well above the top end of that range. And that is after both the buyback program and supporting, very importantly, clients and client growth in this environment. So we have a structural capital surplus, which is a drag on our returns, and the most efficient way to return it to shareholders, all things being equal, is through a buyback program.
Looking ahead, what will you and the team be focusing on?
So certainly, we're going to focus on what we can control, continuing to deliver on our strategy, completing that complete refresh of our tech build, driving up levels of customer satisfaction and client service, improving our market share, in particular in main bank clients and retail transactional deposits. And we think sort of all of those things, if we can continue to focus on those together with collections in the credit environment where many of our customers are under pressure, that should enable us to meet our medium-term targets and continue to drive shareholder value creation.
Do you expect that pressure to continue as we get into that, more sustained increases in interest rates, high inflation, or do you expect that to come down slightly, perhaps going into late this year, early next year?
So we would expect the pressure to continue during 2023. This is still an environment of extraordinary high levels of load shedding on the one hand, and we think interest rates probably have another 25 basis points of hiking to go. And that would then take us to the peak of the cycle before rates begin, hopefully, to fall again in 2024 off the back of a reduction in inflation. So it'll probably take until 2024 before that reduction in interest rates begins to feed back more meaningfully into customer affordability.
Mike, thank you so much for your time. That is Mike Brown, who is the CEO of Nedbank. And just to go back on that share buyback program, basically over the next 12 months via an odd lot offer, which will see it repurchase equity from shareholders, specifically those that are less than 100 ordinary shares. Well, we're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.